Howdy, Team 42. It's your skipper here, Darius Dale, to present our Around the Horn for Saturday, December 11, 2021. Starting with our key takeaways here on slide 3. From a short-term perspective, inflation ended the week as the dominant market regime still, but deflation is making a strong push to commandeer that status. Investors should expect even more realized volatility in risk assets if that occurs. For example, the mean realized volatility in S&P 500 is 500 basis points higher in deflation than it is in inflation. Friday's inline November US CPI data keeps the hashtag accelerated taper in play next week. And to the extent the Fed transitions from 15 billion of tapering a month to 30 billion a month, we could be set up for liftoff as soon as March. Eurodollar futures are still calling for June, however. Lastly, our crowding analysis is pointing to an investor consensus that is ill positioned for any hawkish surprise or any other unforeseen negative catalyst heading into next week. Stay vigilant. With respect to the medium term, our math suggests inflation is the most probable bottom-up macro regime for the U.S. and global economies in the 3 months through February of 2022. That same math suggests deflation is the most probable bottom-up macro regime for the U.S. and global economies in the 6 months through May 22. Both Goldilocks and reflation remain low probability outcomes in either window. As such, we find it prudent to continue reducing our exposure to high beta risk assets in an effort to high grade our portfolio construction. That means traversing up the capital structure and in on the risk spectrum. While hashtag Omicron is likely no longer the risk to the economy as initially feared, the increasingly likely derailment of President Biden's economic agenda represents a bigger market risk because the heightened fiscal drag represents a more sustainable headwind to medium to long-term growth expectations. Reported inflation dynamics continue to siphon leverage from progressives to Senators Manchin and Sinema in ongoing Build Back Better negotiations. With respect to our portfolio construction, no buys this week. On Friday, we sold blockchain, Ethereum, Bitcoin, the RORO ETF, risk on, risk off, and then S&P 500 with a Bitcoin kicker. Just getting rid of some of the crypto exposure. We do not like the liquidity characteristics in that asset class. We think liquidity will become an increasingly a bigger issue for asset markets over the medium term. So as long as we, the positions aren't acting right now, we certainly don't want to be heading into a week like next week in terms of the hawkish Fed pivot with investors having covered shorts and monetized puts into that. That's a big risk, market risk from our perspective. Oversold signal, U.S. dollar, overbought signal in China A shares KBA. If you look at a real sort of real aggregate weekly earnings on a real basis that we got out of the CPI report, down 2% year over year. If you have households with down 2% year over year wages, it's very unlikely we see a consumption boom in that context. So going back to where we started this rant. I apologize for the rant. This is why the 10-2 curve is collapsing in our opinion. So be aware of that. Also be aware on slide 11 that investor consensus is probably too long of high beta exposures. If you think about commodities and crypto in the context of our data-driven outlook. So everybody's talking about alternative assets and inflation this and let's go buy more commodities, less bonds, more crypto, less bonds, and less cash. Cash is trash. And so, we've seen this big move higher. This black line is our high beta to low beta ratio. And we've seen this massive move higher in the year to date. We've been hodling kind of around these levels since, kind of early March. Certainly this everyone remembers that call, that destruction of the reflation trade in June. We got the mini reflation trade bounce, and now we're just backing off. What if we just had like a triple top? This actually, if you erase all that, this looks like a head and shoulders pattern, is it? Is that a head and shoulders? Darius Dale, the chartered market technician. That looks like we got a head and shoulders in the high beta ratio, low beta ratio. And the reason I bring that up is because, as you can see, it tends to be correlated with the economic cycle. These are the OECD composite leading indices for the US, China, Euro area, Japan, OECD, and they all came out. As you can see, if I zoom in, we zoom in a little. Actually, I don't want to zoom in because I don't know how to zoom out. I'm not very technically savvy with this program. But anyway, you can zoom in on your own time and see that all these economies are really cresting off their cycle peaks. Obviously, China led to the downside and should bottom sooner. But again, we're kind of early in this slowing process. So, where are we going? The high beta, low beta ratio is in a very it's kind of in no man's land. And if you think about a multi-quarter slowdown in global growth. So be aware of that. Don't be the guy who buys the head and shoulders pattern into the sea of blue that we just talking about. Please just acknowledge the colors. We try to make it easy for you guys. It's a lot of work goes into producing this table. There's, like I said, several thousand data points that contribute to this table. But hopefully the color coding makes it easy to interpret and react to. On slide 12, a negatively sloped net liquidity curve is increasingly within reach. So this is something we've been talking about all year in terms of, okay, whenever this blue line, this is net liquidity as calculated by the Fed's balance sheet minus the Treasury General account. So when the Treasury General account goes up, that's when you see tightening. When Treasury General account goes down, that's when the fiscal authority is easing at the margins, supplying liquidity to the market, to the economy. And so that's why the negatives cancel themselves out. So, but the reality is, because of tapering, we knew that this exponential rise in the liquidity curve was going to transition to a logarithmic curve. But now we're on the other side of the budget or sort of the debt ceiling, and now the Fed's back in the market, tapping the market. And at some point in the next, we're going to go from the Fed tapering 90 billion, or we're going to get 90 billion of QE in December to potentially 0 billion of QE by March or April. And so to me, that really kind of pulls forward a lot of the negativity we could potentially see in the slope of this line. And the reason I bring that up is because the obvious takeaway is that whenever the slope of this line flattens out, you typically see a tremendous amount of volatility in financial markets. Obviously, 2018 kind of being the most recent iteration of that. We actually kind of saw it you saw a little bit of it in 2020 as well. I mean, just look, the line started going the wrong way, just at precisely the wrong time into a global shutdown. So be aware of this. This curve scares me. Part of the reason why we got rid of a lot of crypto exposure is because, just quite frankly, what's the bull case? Like, I get that everyone kind of talks about this sort of like, this nirvana of Ethereum in March of this year, next year, and Bitcoin. I had 100,000 Bitcoin price target that very much looks like it's not coming to fruition. I don't understand the bull case for higher beta risk assets from this point forward. I certainly understand the bull case for being for high grading the portfolio construction with respect to traversing up the capital structure, reining in risk. But I don't really see the bull case for an explosive move higher in your traditional higher beta risk assets from here. I do believe, and that's something I believe the market is agreeing with me on. If you look at slide 13 here, so one of our DDs, one of our Sunny D isms is liquidity dries up at the margins. And so when you start to have problems with market structure and liquidity, it always starts it starts far away from the S&P, starts far away from the Treasury market, starts far away from the US dollar. It always starts in places that maybe you're not paying attention to, or certainly in places where investors aren't going to let you out to the extent you need that liquidity. And so the thing that caught my attention is that ARK, the Kathy Woods issues she's had a great run. So you go up 500% and go down 25%, you're still up a lot. Anyway, so but to be clear, we want to avoid the down 25%. That's the whole point of engaging with a macro risk manager like myself. But taking it back to this chart, we had ARK break to new lows this week. Obviously, it's bearish VAMs, but the fact that it broke to new lows this week, again, this is the week where we had the reprieve from the Omicron, right? This is the week where everybody's like, okay, phew, it's not going to be that. This is also the week where everyone's like, tapering's priced in. Or not, sorry, the accelerated taper is priced in. The more hawkish Fed is priced in. The dot plot revision is priced in. Oh, by the way, they might start talking about balance sheet reduction pretty soon. Maybe that's priced in too. I just don't buy that all this stuff is priced in. You got microcaps and ARK breaking to new lows this week. Not last week or the week before with Omicron, this week. So this to me is a stealth signal that all is not well in financial markets.